Well, business news. India's central bank has taken investors by surprise with a larger than expected slash to interest rates while making it easier for banks to lend money. The Reserve Bank of India lowered its key repo rate by 50 basis points to 5.5%. Most analysts had expected a 25 basis point cut as the third reduction in a row since February. Policymakers pushing to boost sluggish economic growth. Governor Sanjay Malhotra says front-loading the rate cut was necessary to support demand at a time of rising uncertainty. The central bank also slashing the level of cash that banks are required to hold. Well, that's the so-called cash reserve ratio, the same level it was in the COVID-19 era. But it shifted its monetary policy stance to neutral from accommodative, indicating it may have limited space for any further easing. For more, we're joined by Shubhada Rao, founder of QuantEco Research, speak to us from Mumbai. Dr. Rao, if the point of this three-pronged move was, and I quote the central bank governor, was to inject certainty into an uncertain environment, has he succeeded?
Absolutely. Thank you, Visu, for having me there. Good evening. Quite a surprise, the Reserve Bank of India delivered and over-delivered to the market by cutting the rates by 50 basis points. While the markets were expecting 25, 50 was completing the entire rate cutting cycle in one go. So between February and today, we have 100 basis point rate cut. Add to that the liquidity bonanza, which was totally unexpected by the market. While the Reserve Bank of India has been injecting liquidity of a durable kind through open market operations, the move on the reduction of cash reserve ratio was entirely unexpected. And as the governor had alluded to, he wanted to impart a certain path of certainty for the banking system to work its way for a better transmission of the reduced policy rates over onto the credit markets. And the third and the last surprise was obviously the one where the stance was changed from accommodative to neutral, initially and startlingly telling the markets that from here on, the space for future rate cuts remains extremely limited. Whatever the growth support was needed by the central bank's actions has been delivered fair and square in one go in a bazooka right today.
Dr. Rao, the problem with the bazooka is that if that bazooka does not deliver as one hopes it might, there is nothing left in your arsenal.
Quite right, Visu. I think, India has been struggling to push the demand, domestic demand, particularly on the investment side coming from the private sector. As far as the consumption demand is concerned, India has begun to do better, both in terms of rural and urban demand getting stronger with each quarter. I think what has been the weak link in India's growth story currently is the private sector investment capex demand, which unfortunately has still remained in the sidelines, has remained in the wings, all thanks to the global uncertainty and the spillover risks. Therefore, the visibility of domestic demand combined with the global spillover risks have kept private sector capex plans and appetite fairly low. This is one time the RBI has begun to take a risk of nudging the private sector to go on and extend credit to the industry at a much cheaper rate. And that is why the liquidity alongside aggressive rate cut combination has been executed and delivered today. Yes, as you rightly pointed out, is there a risk? I would say that there has been more of an organic, gradual pace of recovery, even in the private sector investment, though it's not broad-based, though it is relatively weaker compared to the previous capex cycle. But if the domestic consumption demand begins to improve very sharply over the next 1 or 2 quarters, I think that would spur the domestic investment story as well. So I think there is a little bit of a betting on domestic growth.
All right. Dr. Rao, a very quick answer to this. Bank loan growth dipping in May. So the idea is that by making it easier to lend and making banks keep requiring them to keep less in their reserves, this would boost the lending, and therefore businesses might lend and therefore invest. And that's the capex you're mentioning. But as the central bank governor said, monetary policy is not a sufficient condition. It's necessary, but that's not enough. The private sector, as you mentioned, really needs to pick up. And these moves will be what the private sector needs to see to have that confidence very quickly.
Yeah, I think quite, predictably, growth is going to be at 6.5%, similar to the year gone by. More or less, we anticipate all the rate cut positive spillovers to begin manifesting in fiscal 27, starting April of 26. So it's going to be a gradual pace of growth recovery, but nevertheless, it has cushioned any downside with all the monetary and fiscal support that the country has seen over the last few quarters. So I would think that India is poised to get better in terms of growth trajectory going over the next 18 to 24 months.
Well, you look at least 6 to 9 months before these changes translate into actual positive effects in the real economy. So the central bank, final question here, Dr. Rao, you feel it is not premature. It has, though, shifted gear. And this is the right gear that the RBI needs to be adopting. Final question.
Absolutely. It has shifted gear. It has shifted lanes, everything to support growth. 9 months of lag of the rates to feed into the real economy. I think by the last quarter of this year, we will see the early signs of a smarter and sharper growth recovery. So we are more hopeful of 6.5 going closer to 7 as we move into the next 3 or 4 quarters. If global trade tensions do not aggravate from here on, at least from India's standpoint.
Oh, thanks for that. Dr. Shubhada Rao, founder of QuantEco Research, speaking to us live there from Mumbai.